The Multiplex Association of India, under the banner of FICCI, has issued a statement, and this is on Friday, saying that they like to clarify on the media reports regarding the Maharashtra government's reported decision allowing outside food in cinemas. And they're saying that there have been various media reports which seem to be suggesting so. But in this regard, they're saying that they wish to clarify that none of the multiplex cinema theatres operated by any of their members, and I would assume that would obviously include the large multiplex owners, the likes of a PVR, Inox, have received any order or notification or communication to this effect from the government of Maharashtra or any other regulatory authority. Hence, we are not aware of any decision to this effect if taken by the government. Let's take this discussion forward, and Sandeep Sabharwal as well as Kunj Bansal as well join in. Sandeep, morning to you first and welcome back firstly. How is it that you're going to approach this entire event, given that F&B constitutes as large as 25 to 30% of the revenue pie for players like PVR, and within that Maharashtra constitutes about almost 25 to 30% again of the pie. So this is definitely going to be bad news if it gets implemented.
Yeah, so I think there are two parts to the entire analysis. The first part is that obviously this has happened because the prices got ramped up very significantly in terms of F&B prices. So I think across most of the multiplexes, they have almost doubled over the last 3-4 years. And to get around the water MRP selling issue, they also rebranded the same bottles and bought them at a higher price. So I think there are a lot of things which they have done, so which have ultimately led to the situation coming to this level. On a gross margin basis, they earn around 80% on F&B, which is very, very high. So I think from their perspective, I think they need to retrospect. From the perspective of the actual impact, I think what's going to happen is that even if such a thing gets implemented, 90% of the people will still buy from the multiplex. 5-10% might carry something from outside. So the actual impact might be much, much lower than what the sentimental impact is. Now we need to see how this things gets carried forward, but I think overall, given the state of the mid-cap market, this could create some more downside in the near term. But then stocks like PVR, which are long-term very good stories, need to be bought in some sort of a panic or negativity, which comes once a year or once in 2 years. So I think as this plays out, we might find buy levels in this stock.
And it seems that Eros definitely did find some buyers. If we bring up the intraday chart of, I beg your pardon, not Eros, Inox International, Inox Media that is, and that really saw sharp recovery within the dying minutes of trade towards close, and that recovered quite swiftly from the lows of the day. So after having nosedived and seeing some double-digit cuts, much in line with PVR, of course PVR was the hardest hit, Inox actually saw a fair amount of recovery coming in and closed just, you know, these are post-adjustment levels, so which is why you're seeing a 6% cut, but it almost made it to the green, if I'm not mistaken.
Yeah, it did, but that was not the luck with PVR, and as Kunj pointed out, that it's basically a valuation issue, and PVR has more revenues coming from Maharashtra. That was the reason as such.
Yeah. Kunj, how is it that you would approach these multiplex stocks, and do you think this dip is a buying opportunity? Because the only fear here is, what if after Maharashtra other states also get to implement such sort of a move? Then what happens? Then you got to rethink your investment case, whether you should be buying multiplexes at all or not.
Yeah, so whenever we invest in any company, there are two kinds of risks that are there. One are the possible risk that will arise. So just to clarify, giving an example, we have seen housing finance sector underperforming for last 7-8 months or so, which was obviously because of the interest rate rising. Their NIMs were seen to be compressing, and as a result such business models would come under pressure at these points of time. Now this is a risk coming to multiplexes, wherein the possibility of their food prices being controlled is a risk probably not unseen, but the probability of which was very little. So it's a low probability, high impact event. and this changes the whole business model of the company. Let's keep in mind that we analyze, or when we invest in multiplex stocks, we obviously look at the revenues from multiple sources, main two of which are the ticket revenues and F&B revenues. Now F&B revenues are anywhere in the range of around 30-40% for all these companies. Now if that is being attacked by one of the major states, you are right that it will get extended, it could get extended, and these days there is anyway too much of hyperactivity by NGOs, by activism, too much of activism by consumers, also by courts. So it's a significant business risk. I think one would possibly be advised to wait before taking a fresh exposure in this sector and stocks.
Certainly, in fact, going from one extreme end to other extreme end, from exuberant prices to allowing food from your home or probably outside. Let's see how it pans out, but certainly stocks were under pressure. As Aisha pointed out, Inox was one stock which showed rebound, but there was no such luck with PVR. Let's take some more trading ideas at this point of time, and IT would be in limelight because of what Infosys announced, not just from the result perspective, but also bonus. Dr. Nayan, mid-cap IT space has been doing well. Emphasis is something which you have, shortlisted to give as a buy call?
Yes, indeed. I think mid-cap IT is where the focus is and where the money flow is, and if you look at many of these names, the better names in that pack, you'll find that their trends have been very strong and very consistent over the past 12 or even 18 months, and that would also include Emphasis, where if you take for the last year, there has been a very, very strong uptrend, and the last 7-8 weeks, the stock has actually undergone a consolidation, which on the charts would depict in the form of a triangle pattern. And then in the week just expired, I think it has staged an upside breakout, which should now see further gains being made in the stock of Emphasis, because it's well accompanied by decent increase in volumes and very good surge in momentum. So I would believe that even at 1200 rupees, Emphasis is certainly a buy for not for a day trade type, but certainly for a multi-day, multi-week kind of position. At the bare minimum, we could look for about 1300 as a target. So therefore, a positional long on Emphasis.
Emphasis, we don't talk about that stock much when it comes to mid-cap IT space, which is surrounded by KPIT, Mindtree, Tata Elxsi and Hexawares of the world. Kunal, you are buying Torrent Power. We did see Adani Power doing well, but when it comes to PSU names and the related space like PFC, REC or power companies, state power companies, all of them are in a negative trend. What are you seeing on Torrent Power? But because we didn't see significant volumes in last trading session.
So Siddharth, I think 215 to 20 has been a major support zone. I think over the last 4 months from February or March, the stock has been testing this support zone, and there have been fierce rallies emerging from those levels. And I think on Friday also it's sort of entered into that same territory, 220, 215 kind of range. More importantly, on Friday the candlestick was pretty attractive. It's more or less like a bullish hammer pattern for Torrent Power in terms of Friday's candlestick pattern, and I think both of them coupled indicates that the stock should form a short-term bottom over here. 236 is the target which I am eyeing on the stock. Stop us at 222.
Manas, just when we started talking about that, how cement sector probably is showing signs of bottom and probably moving higher, all those stocks went for toss, and now we are seeing Ambuja Cement. It has closed lowest point since November 2016. What exactly you are mapping on charts?
Siddharth, after almost 20-25 rupees correction, correction this year, we have seen some recovery a few weeks back in most of the cement counters, and most of them could not sustain on high levels, and especially Ambuja Cement, where on Friday we have seen a breakdown on the daily charts, and the stock has broken the lower band of the triangle pattern on the daily charts. Oscillators are showing negative crossovers, so the possibility is very high that it can even break its recent low, and it can go down and test 187. So take a short call here and keep the stop loss above 202.
Well, lots of key earnings this week. You'll have Unilever today, then you've got Ultratech Cement, Kotak Mahindra Bank, Bajaj Auto, Wipro, Zee Entertainment, Federal Bank, Bajaj Finance, Havers. These are all going to be extremely critical numbers. Aside of that, you'll also have the June WPI numbers as well, an upcoming monsoon session of Parliament, which would be in focus. Remember, there are 50 pending bills and 6 ordinances which are still to be taken up. So that's the action and lineup of this week's events. But let's analyze how the street is going to absorb Infy's numbers. Kunj, it's been a mixed bag, but given the concentration of positions within IT, how do you think the stock may perform? Do you think that bonus announcement could keep it afloat today?
Yeah, so you always try to hand out a lollipop to compensate for few other things. In case of IT sector, it's not only the absolute result on its own of a single company, it's also the comparison that always gets carried out between the two biggies, that is the TCS and Infosys. And in comparative terms, it looks like Infosys numbers haven't been as great as TCS numbers are being seen to be. So to that extent, I think stock could underperform. Bonus is there, it might have a short-term bump up, although it doesn't look like that will help. But the stock looks fully valued. The results are not really great unless we see significant revenue growth in the coming quarters.
Sandeep, we've been debating that this market is very narrow, but frankly, a point which I was discussing on Thursday was that, is this market really narrow? Because Reliance at an all-time high, HUL at an all-time high, TCS at an all-time high, Bajaj Finserv at an all-time high, Bajaj Finance at an all-time high, HDFC Bank and Kotak Mahindra Bank at an all-time high. So the small cap stocks may not be at an all-time high, but large part of the market which represents bulk of the earnings or where the earnings momentum is, I think those stocks are at an all-time high. And if Reliance, HUL, Kotak Mahindra Bank, Bajaj Finance, if these stocks are at an all-time high, for me that is a very diversified kind of an market.
Yeah, so I think it's diversified, but again, in a narrow set of companies which represent the bluest of blue chips in a sense, and to that extent, at one part it's perfectly fine because a lot of the foreign FI investors or a lot of investors in mutual funds who would only be in large cap schemes, I think they are still seeing higher levels, and it's obviously good for sentiments. But we've seen that very established companies also on the mid cap side, irrespective of fundamentals, have corrected significantly. So there is no euphoria surrounding the 11,000 level because most people's portfolios who have been investing on active basis are down at least 10 to 15%, if not more. So I think that's the state of the market. But then these phases come because obviously stock markets are not monthly income schemes where every month you're going to make money, and that's what people started thinking last 2 years. So it doesn't work that way. So I think because stock markets give you higher returns, there are risks associated, and those risks are playing out today. Whether this state will continue forever, I don't think so, because I believe that the global equity market outlook is still very positive, which includes India. And but for these trade war talks, which will also fade away over a period of time, we would have seen the sentiments being much better off.
DRL, that's going to be another stock which is going to be in focus. Remember, US court has thrown open a spanner in the drug maker's Suboxone launch. They've ruled in favor of the competitor, that's Indivior. And DRL, though, has issued a statement saying that they will now be appealing in a higher court. So it's not a done deal yet. But sentimentally, we could see DRL take a bit of a step back, considering they were really pegging and banking on the Suboxone launch. And we all know how critical this one was for them. And considering the approval came by only just about last week or 10 days back itself. Do you think this dip should be bought because eventually maybe DRL will win when they do appeal in a higher court? Or do you think this is an opportunity to actually sell if you bought after the approval?
So frankly, I don't particularly track DRL as closely for me to be able to give that view. But on the face of it, this development does seem negative.
Okay, now I just want to revisit our 3 stocks and some of the stocks which we've revisited. And before I do that, I also want to mark the total volumes in Inox and PVR. We were really concentrating on this story on Friday afternoon or Friday post 2 o'clock when the announcement kicked in. Let's remember, this is not the law of the land right now. Multiplexes do have an option to go and appeal, and I don't visualize a scenario where actually you can move into a then go to a cinema theater carrying your tiffin box. I don't think that's going to happen. Maybe a middle path would be approached on MRP related products where you may not be allowed to sell above MRP, and I think that's just been fair. A bottled water in multiplexes should not be sold at 50 rupees per liter when the MRP for the best of the brand is not even 40 rupees or even 30 rupees. So I think to be fair, maximum retail price should not change because the location has changed. I mean, you cannot have this double MRP situation going. I mean, that's not been fair to the consumer. That's one stock which is on our radar. PVR was down 13%. The reports are well known, but I just get a sense that somewhere logic and sense would prevail, and the kind of selling what we saw in PVR and Inox, I think was largely concentrated, event driven. In fact, Inox recovered also very smartly from the days low. So I don't think this is going to become a precedence in India, and the F&B revenue for a company like Inox is not even 35% of its total sales. So we'll stay with that theme. We'll try and put out that press release also, which has come from the Multiplex Association. Maruti 94.31. Maruti seems to be regaining its lost mojo. CK, would you go for Maruti this week, or do you think between Maruti and Bajaj Auto deserves a special mention?
Well, I think currently if you see it from a very short-term perspective, few days, then Bajaj Auto currently does have much better momentum in its chart. So perhaps short-term traders could look at Bajaj Auto ahead of Maruti. Maruti has been slipping a tad, and maybe it would be much better to buy into Bajaj Auto for this week. That is a view strictly for the week.
Kunal, while fundamentally there are many reasons why an Inox would have fallen less or recovered more than PVR, their pan-India presence. So in that sense, the concentration and dependence on Maharashtra multiplexes is much lesser. But to your mind, do you think Inox could be bought, and could we actually see a continuation of that recovery today too? And would PVR continue to be sold?
Well, I think a trader has to, if you're a very short-term trader, then you should try and avoid these stocks, because there would be increased amount of volatility into the intraday in prospects. You try and, what we try and look at it is whether these stocks come back to their extreme oversold territory, strong support zones, and then the sell-off, or the volatility drops off. If that happens for these stocks, then I believe it could be a better prospect to enter into these names. I think on the other hand, the recovery which we had seen on Friday, especially for Inox, I think it was more or less led by slightly lesser volumes as compared to the fall which had transpired in the first half of that sell-off. So I would wait for some bit of confirmation. If the stock continues to show increased volumes and then stable recovery, then there could be a case that you might see the stocks recovering and heading up higher.
Okay, the other important stock to look out for today is going to be Unilever. Remember, it reports its numbers while we are expecting a sales surge of about 12.5%, and these are the standalone polls that I'm talking about. EBITDA margin is expected to go up by about 17.5% again. Margins of about 22.9% as opposed to 21.9% as a variable. The key monitorables for any FMCG company would be the volume growth. Now, we're expecting a 12% volume growth as opposed to a flat growth in the base quarter. Also, better rural growth, which is going to perhaps further aid top line. We all know good monsoons, MSP, etc. are all combination factors. And to be frank, this is a trend that you saw in the previous quarter as well, that most of these rural-focused FMCG plays did post better volume traction than the urban concentrated ones. So yeah, you're going to look out for the underlying volume growth in the core FMCG segment, the price mix growth post the cuts in GST in November, because there's definitely that base effect which would help and aid any and every company. Also, rural recovery growth, what is the management feeling about their margin trajectory, and inflation in pricing in key raw materials, because I think what has changed from the previous quarter to now is definitely the RMC cost. So how is it that they plan to actually leverage onto that or balance that out? So that's going to be another key monitorable to look out for. The pre-open rates, let's quickly mark them and let's see what the rupee opening has been like, because after yet again having a touch and go moment with that 69 to the dollar mark, this morning it's the trade data which perhaps is going to create a bit of a havoc when it comes to the currency markets. Hasn't been all that strong, so maybe it's going to weigh in a little bit heavy, the trade data. wherein the macro concerns clearly have deepened. The trade deficit for the month of June, remember, has shot up to a 5-year high. It's spiked more than 13% now to over $16 billion, and this is coming on the back of a surge in oil imports, putting further pressure on the fisc. This is much known news, so I'm not quite sure how much the market is going to react to. But let's just see what the rupee open is like before we get back to the stocks. That will just come up for you on your screens.
Well, whichever way I look at the current setup is much more stable than what we've reported in a long time. Large cap stocks are sitting at a record high. Dollar index is not at a record high. Flows have stabilized. Crude has stopped appreciating and mid-cap stocks have stopped falling. So the lay of the land is far more constructive than what we've seen in a long time. I mean, frankly, my sense is that we've put behind a very dark quarter of price performance for emerging markets. Will that repeat itself, or this is a temporary relief? I think that's a very difficult answer. But bulk of the concentration from a market standpoint this week would be centered around numbers and more numbers. Kunj, what has been your last big acquisition? What have you acquired last? Where have you invested last?
So these questions are really very difficult to answer.
Very simple question.
Yeah, sure.
From a classmate to another classmate.
No, because it depends on the investment horizon. It depends on the perspective.
You can
there
qualify,
are multiple things.
You can qualify it. Let's say, what have you bought in your investment portfolio for next 2 to 3 years?
So PNB Housing,
Okay.
Since you want a specific name, is one name. One or two reasons in a very short. One, now of course after a lot of speculation over the last few months, the existing management has clearly announced officially that they are intending to divest 51% stake, the PNB itself and the private equity partner. So the overhang is over. Hopefully they should be able to divest it at a premium. Two, the valuation has come down significantly, obviously based on the reasons that names were seen to be and did come under compression because of the rising yield. There may be some bit more of the yield hike going up from here, but I think the lag for the compression to get into there is over. The growth number continue to be good. So over the last multiple quarters, including the last 2, 3, 4 quarters, which have been in general a pressure quarter for the economy as a whole, the growth has been anywhere in the range of 20 to 30%. So that's the investment that we have made.
Why a stock like Growth Finance is still outperforming the HFC space? HFC stocks have seen a time-wise and a price-wise correction, but the standout gainer there is Growth Finance. Expensive, I think, is an understatement for Growth Finance because it's trading at a price to book of 13-14 times, and a lakh rupees invested in Growth Finance 9 years ago has now become 80 lakh rupees. It was expensive 10 years ago, it is expensive today also.
So before I come to the answer to your question, just giving some numbers, not the 7, 8, 10 years numbers, but last 1 year, if we look at specifically the housing finance sector, PNB, which I was talking of just now, and Canfin, the other partner in the industry, are down about 30-40%. Few other stocks in the housing finance are similarly down, and few others are flat. Growth Finance is the only stock which is up about 30-35% in last 1 year, and you are right that it was expensive before rising 35% 1 year ago, and it has become more expensive. Frankly, I don't have an answer as to why this happens. The only possibility I can think of is that it's a small market cap, low liquid stock, and probably the demand for stock continues to go up. Why it continues to go up, I don't have an answer, because the financials of other housing finance companies are not bad in comparison to Growth Finance.
That's my limited point. The other one which could be a talking point, Aisha, this week would be that you've got, decks are cleared for HDFC AMC.
Yeah.
Now, if decks are cleared for HDFC AMC, I don't think on a sum of part basis it will move the needle a lot for HDFC Limited. It's important for HDFC Limited, but frankly, I mean, with the profit projections of about 700-800 to 1,000 crore, it's not going to change life for anyone. But from a market standpoint, you got Motilal Oswal and you also have Reliance AMC. So Motilal Oswal is a smaller player. Reliance AMC is number 7, number 5 or 6 there in terms of ranking. So that space now becomes an interesting space in the run-up to the HDFC AMC IPO.
Yeah, it sure does. Aside of that, it's really about all about earnings this morning. PC Jewelers, and Kunj, I'm sure you don't really track the story, but this is looking a little grey. Because now the buyback has been recalled. They're saying that auditors and bankers have said that there is not enough cash on the books. Do you think that fall that we've seen in PC Jewelers was well justified? Because the story is getting so murky now.
Yeah, so So, I don't know about the fall, whether it was justified or not. It obviously looks justified, but 2 or 3 points I have been hovering into my mind. One, a similar announcement of buyback and then withdrawal have been seen multiple times in the past, and stocks have been treated in the same way. The recent example being Quality Limited. They announced a buyback despite heavy debt on the books and then announced the withdrawal. So, that's one. The same is the case with PC Jeweler. On the auditor point, I think there needs to be done a lot more in detail. Auditors till the last quarter were seen to be getting all the information that they needed, in fact, to go extend this whole discussion to the Manpasand. Now, auditors withdrew, presumably saying that they did not get the desired information that they wanted from the management. The question is, have auditors explained to the shareholders that were they getting it till last quarter or last financial year when they signed the annual report? And if yes, what has changed? And if no, how did they sign the earlier quarterly numbers or the annual numbers? So, yes, coming from the investment point of view, obviously, we were a while ago discussing about the PVR also. These all events become unseen risks. The risks which you would normally not build into your analysis, because if you try to build in all these risks, you will never be able to invest in equities. Then you better move on to fixed income, which is also not sure for that matter. So that's a problem. We have to live with it.
Okay. Another stock idea, here's Santosh Singh from Haitong Securities. He's betting big on Motherson Sumi with new projects now in their kitty. It is expected to add a revenue of 2 billion is what he's saying at their peak capacity.
Motherson Sumi. Again, this is one stock which has done really well over years, but in last 1 year, the stock has underperformed. It has come off in the recent times almost 25%. It has come off almost 25%, and it's trading at sub 20 times earnings on a FY20 basis. We are expecting more than 30% increase in EPS over years because we expect the reduction in the copper prices to benefit it positively, and then there is a ramp up in capacity coming up which should add the top line. So overall, around 18 times FY20 valuations for almost 30% EPS growth CAGR for 3 years is not demanding for a very high quality franchise.
Well, Motherson Sumi and most of the auto ancillary space have underperformed in the last 1 year, as the speaker was also talking about. But yes, it's a long-term buy, and buy on dip strategy should be adopted. Let's discuss some more stocks from futures segment, and Tata Global. Now that stock was under pressure, down around 3.5–4% in last trading session, 11% rise in open interest, suggesting that these were shorts which got formed and it was not just some random correction. Now this is second consecutive day that stock has closed below its 200 DMA, and it's a decisive move below 200 DMA, which is also a negative observation. And last but not the least, support of 255. That might get challenged the way price action is happening. That's what statistics are revealing. So watch out for this name. The other one is FMCG Major, and a stock which has been underperforming in FMCG space, ITC. Yes, it did show some bounce back, but then that's getting sold into, and how short positions were getting formed. Since last 3 trading sessions, we have seen accumulation of short positions. Even if you dwell further, then cash volumes in last trading session were at 3-month high, which means when stock is moving higher, volumes are not that great, and when it's coming down with high volumes, which means that the underperformance probably in FMCG space would continue, and even on standalone basis, stock might underperform, and that is what oscillators are also saying. They have turned negative, the momentum oscillators like RSI and all. So these were a few observations when it comes to future segment. We discussed with our technical experts that what stocks they are liking, and probably there were some short ideas as well. But when it comes to index, we have Manas, who's bullish on Nifty IT and suggesting that 14,900 is pretty achievable and keep a stop loss of 14,300. If you look at Kunal, then he is optimistic on Nifty, Bank Nifty. He has been maintaining bullish stance on Bank Nifty with the target now at 27,250 and stop of 26,750. And consistency from Dr. Narayan when it comes to index trade. Nifty is a buy for him for a target of 11,080 and a stop of 10,930.
Well, the three stocks that we've been focusing in on purely on the basis of the price movements in Friday's session, and PVR that managed to hit a 9-month low, the biggest intraday loss that the stock has seen in 5 years. And just to put it into perspective, it's the market cap erosion in PVR just on the basis of Friday's fall has been in excess of 700 crore rupees, and that is just the one-day hit that PVR has taken. The other one, of course, Jindal Steel, which has managed to hit a 6-month low. It's been the top loser on the Nifty Metal Index. It's breached its 200 DMA as well, so that's another stock that we're going to be looking out for. And then Z, I hate to say that we're only pointing out all the losers. There's lots that moved in the market as well, but I'll come to that in just a bit. But Z also managed to hit an 11-month low. It's fallen now for a good 4 sessions out of the 5 last sessions, and it really tumbled. Macquarie cut its target price to 615 in the stock, and you saw a bit of a sharp move coming in. Volumes as well, by the way, were almost about 1.5 times the 5-day averages. So that's another stock that we're going to be looking out for. Kunal, a quick take on Jindal Steel as well before we move forward. There were the ED charges which came by on Naveen Jindal, and I guess which is why you saw this knee-jerk reaction coming in on the stock. But do you sense there could be follow-through selling today too?
I think there should be some short-term selling through follow-through of selling, because on Friday what was sort of different than the other days of sell-off was the heightened amount of increase in volume patterns, and the stock managed to break this 200-day moving average second time. The first time the attempt for a break, the stock consolidated and then pushed back up again higher. But on Friday after that news and the sell-off, it confirmed a break of this long-term average, and that too with higher volume. So I think that itself indicates that maybe from a very short-term view, the stock could drag lower another 10 to 16 rupees is what I would expect that the stock should correct to 192, 194 could be a short-term level where the stock can see.
Okay, 3 minutes to go. As you walk into trade this morning, I quickly want to recap the factors which are at play. 5 factors which we always identify which could be at play. And then I'm coming to Kunj Bansal after the Kunj Bansal to you for a quick stock idea. Number 1 factor is that we are outperforming global markets. I think that's clearly visible. The market breadth has stabilized, and Nifty is now sitting at 11K. Who would have thought that Nifty actually would be at 11K? But yes, Nifty is sitting at 11K. This is the earnings season, and today we'll hear from HUL. As we progress further this week, you have Bajaj and you have other companies which are going to be important, Bajaj Finance and Bajaj Finserv, which are going to be important in terms of a market, in terms of the earnings scorecard. Crude has stopped appreciating, and the mid-cap stocks, they have stopped falling, and brokerages actually are mixed when it comes to their outlook on Infosys. But for me, the key indicator, I guess, would be again the market breadth, which would be a meaningful indicator of what is happening to the broader market and the HNI market. And the market breadth, 3 out of last 5 days last week was positive, 2 days it was negative. Unlike in the month of June and July, where 10 days on the trot, 12 days on the trot, the mid-cap breadth was dented and the mid-cap breadth was horribly bad. Kunj, what are you not buying in this market, in the small cap space? That is an important list also.
Yeah. So, again, before I give exact answer to this question, if you allow me a little bit of time, I just want to analyze the market. Now, today in terms of large cap indices, we are actually at life highs, which was touched on 29 January. And it's almost 6.5 months since now. Now, what has moved? So, while it looks like index has come back, that is only that is the large cap indices, Sensex and Nifty. That is not the case with mid and small caps. Within large cap indices also, it's very few stocks or sectors. So while they might be covering a large part of market cap of the listed space of the Indian market, but in terms of number of stocks and sectors, it's very limited. In terms of sectors, it's the select private sector financials. It's not the broader financials. Followed by select IT, followed by select FMCG. That's the only 3 spaces which have moved up in this 6 months of journey from earlier high to current life high. What has underperformed? There are a lot more. So what has underperformed is clearly commodities, which was a rising star of the 2017. So there are all these oil stocks.
Kunj, I'll tell you what, I have 30 seconds left, and I'll come back to you just for one closing comment also. But right now I need to focus on markets. It's a brand new week. We start with the print of a new high on the index. We start with the print of 11,000 plus on the Nifty. I may sound slightly repetitive with this one, but we are outperforming global markets. The breadth is not bad and flows are not bad. Infosys, Multiplexes, then you got a whole host of mid-cap companies which came out with numbers over the weekend like DCB and Bajaj Corp, which will be in focus.